Welcome back to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, you can find us at zinniawealth.com, ZINNIA wealth.com. All right, so Charisse, we're getting toward the end of January, and the W-2s and the 1099s are coming out, and people are buying their tax software, and it's time to do taxes. Mm-hmm. And so many of you who are going to get a refund, you can't wait to go out there and start doing the figuring. But if you're not going to get a refund, you probably leave this until the last part of March and first part of April. But there are some things that people don't know. Certainly, that tax code is about 100,000 pages long. How are you going to know all of that? But we don't want to leave money on the table, Charisse. So walk us through. You've got a list today of some things that people usually leave on the table because they're just simply unaware and they need to know these things. So let's talk through them.
Yeah. So what are the most popular tax deductions that retirees miss when you're doing your own taxes? Because I know a lot of people, have programs and they're doing it on their own. And it seems like the single filers tend to miss it the most, but also joint filers. So I just want to go through a few of them. Really, there's like 8 of them, but I'm going to go through what I think are the top 4. The first one is the extra deduction you get for being 65 and older. Some people don't realize that they get, when you're a single person, you get an extra $1,850 as a single filer on top of your standard deduction. So there is this data out there saying people are missing that, right? And then let's say you're married and let's say one of you are 65 and the other one isn't. That means you get $1,550. And once the second spouse turns 65, you get a total extra of $3,000 of a tax deduction on top of your regular standard deduction.
Nice.
So we want to make sure we don't forget that. And when you're doing your own taxes, it's easily forgotten, right? So that's one of them.
Okay.
There's a saver's credit of $2,000, but there's 2 requirements that you have to meet. When you come in and see us, we can talk about that. But you could Google the saver's credit. And it's really income orientated based on, are you paying taxes on Social Security, pensions, annuities, et cetera? Because a lot of people are not. So if you are not, there's some positive extra tax. It's actually a tax credit. So it's not even a deduction. It's even better, in my opinion.
Okay.
One other thing that I noticed that I read about, but I already knew it was happening, we get a lot of retirees who are working part-time, and maybe they're making $10,000 a year. You know that they can still contribute to their own personal IRA. If they have an IRA wherever they're at, let's say they're retired, they moved their 401k, rolled it to an IRA, wherever it is locally, you can contribute to the IRA, right? And it's really important to understand this because you used to be able to contribute if you're 50 and over $7,000 a year. Now in 2024, it's $8,000 a year. And if you have a spouse who isn't working, well, you can do another $8,000 for them, right? Okay. So people forget that they can keep contributing. But in my opinion, the retiree doesn't necessarily need the tax write-off depending on where they've saved their money. Some people do, some people don't. I like the fact that you can contribute to a Roth IRA if you want to. And if you have a non-working spouse, you can also contribute the $8,000 to the non-working Roth IRA for the spouse. So a lot of people forget about that. They have the extra collateral to do it. And, you can write the check for many of your accounts to get included into those contributions. And I'm all about adding to a Roth IRA. But if we need a deduction this year, hey, maybe that's a good strategy as well. So let's not forget about that. A lot of people are forgetting about it when they can use it as a tool to help save in taxes or grow their tax-free growth. Last but not least, it's probably one of my favorites. It's the QCD rule. We talk about it all the time in the classes, and we talk about it on radio. Qualified charitable distributions. So most retirees, Randy, a lot of them used to itemize. They no longer need to itemize their taxes and all their write-offs because the standard deduction they get now is higher than ever, right? And now that you're over 65, it's even higher, right? You get to add in the extra. So what happens is when people embark into this RMD phase of life where they are forced to pull money out of their retirement accounts and IRAs at a whopping almost 4% the first year they start, well, you have to pay taxes on that. That's the whole point, right? It doesn't mean you have to spend it. You just have to pull it out, pay taxes on it. So if you are doing the short form, that's the standard deduction, And then let's just say you are writing a check to your church or charity out of your bank on the dollars you already paid taxes on. Well, guess what? You don't get to deduct that because you are taking that full standard deduction already. And anything you decide to tithe or donate, you don't get the write-off. But that was a really nice thing you did for them, right? They get it tax-free. So how do you make it work doubly for you if you're taking the standard deduction? Well, instead of writing checks out of your checkbook on dollars that have already been taxed on, take those IRA dollars, because once you hit this RMD phase of life where you're forced to pull money out, you qualify to do this, to file this qualified charitable distribution form. If you're donating $5,000 or tithing $5,000 to a church and you have to take $20,000 out in required minimum distributions, don't do it from your checkbook anymore. This is the biggest mistake people make on the daily. Do it from your retirement accounts, because on that QCD form, you put, hey, this is my church. This is their tax ID number. And of the $20,000 I'm taking, I'm going to live on 15. I'll pay taxes on that part. But I want 5,000 to go there or 10,000 to go there. You can literally take your entire RMD and pay zero taxes on it if you're going to tithe it or give it to a charity, up to $100,000 per Social Security number per year.
Wow.
So that's interesting. That's one of the big ones that were missed. And a lot of people think, hey, I do the standard deductions. They donate to the charities and churches, and they're not realizing they don't get to write that off. So write it off through your IRA. So you are beating Uncle Sam, and they won't even be expecting it.
Well, we talk about how things change in retirement. Through our working lives, taxes are something we pay out of our paycheck. But in retirement, there's things like capital gains and RMDs and QCDs and all these different things. There's so many different aspects of the same stuff that we've been dealing with that we really need some help with. And to get help with that, give Charisse a call. And if it's tax time and you got a tax question there, she has the resources to help you with that. Give us a look on our website, which is ZinniaWealth.com, ZINNIA Wealth.com. And you'll see there a gold button that says Complimentary Retirement Consultation. If you click on that, we'll ask you to put in a little information there, and our team will reach out to you, or you can reach out to us right now, 833-368-3680.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 803-368-3680 or find us online at ZinniaWealth.com.
Charisse Rivers is an investment advisor representative of Zinnia Wealth Advisory, LLC, a registered investment advisor. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Charisse Rivers is licensed in your state, please contact their office. Zinnia Wealth Advisory, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. Any client experiences discussed during this show are unique to that client. They are not meant to imply or suggest you will experience the same results. By contacting us, you may be provided with information about insurance and annuity products offered through Charisse Rivers, NPN Insurance License Number 8718011.